As an options trader, you may have heard of iron condors and iron butterflies. These two similar option strategies attempt to profit if the underlying stock or index stays within a specific price range. Let's look at how these strategies work and why traders might want to use them. An iron condor involves selling one out-of-the-money put and one out-of-the-money call option, while simultaneously buying one deeper out-of-the-money put and one further out-of-the-money call. All the options within this strategy have the same expiration date. Typically, the puts you sell and buy will have lower strike prices than the current stock or index price. The strike prices of the calls you sell and buy will be above. The width between the short and long option strikes on each side influences the position's risk and potential reward. We will discuss the strategy's potential risks and reward in more detail later in this video. It's important to understand that an iron condor and an iron butterfly are constructed by combining two basic option strategies, a bull put spread and a bear call spread. You create an iron condor by combining a bull put spread and a bear call spread with the same expiration date. The short options, sold put and call, define the range where you want the stock to stay, while the long options, bought put and call, limit your risk if the stock moves outside that range. An iron butterfly is constructed similarly, except the short options are at the same strike price. This creates a narrower range of profitability, but a higher potential profit if the stock is right at the strike price at expiration. When choosing strikes for an iron condor, select a range where you believe the stock or index will stay through the option's expiration. One approach is to sell both the put and call around one standard deviation below and above the current price, and buy the put and call around 2 standard deviations below and above. This creates a higher probability trade, which would profit if the stock or index stays within the expected range. If all the options were to expire out of the money, you would keep the premium you receive for selling them. An iron condor's maximum profit is the premium received. However, even though the maximum loss is limited, your losses can be significant if the stock or index moves outside the range. The short options carry the additional risk of assignment, which could happen at any time until they are closed or expired. An alternative approach in choosing the strikes for the iron condor is to sell the put below a support level and the call above resistance. The selected long put and call strikes aim to effectively manage the position's risk and reward. An iron butterfly is similar to an iron condor, except the options you sell are at the same strike price. So you sell one at the money put and one at the money call, while also buying an out-of-the-money lower strike put and an out-of-the-money higher strike call. With an iron butterfly, you want the stock or index to be precisely at the strike price of the options you sold at expiration. If it is, those options expire worthless, allowing you to keep the premium. The further away the underlying price moves, the less premium you keep. Once the price passes the break-even price, the position starts to lose money. Just like the iron condor, the loss is limited. The maximum loss occurs if the stock or index settles at or below the lower strike put or at or above the higher strike call. A significant risk is that you can lose money quickly if the stock or index moves rapidly in the wrong direction. Losses can be substantial if the underlying moves far outside the range of the options you sold, so these strategies are typically used on stocks or indexes you expect to be stable. A feature of iron condors and butterflies is that they profit from a neutral outlook on a stock or index. By selling options and generating a net credit, these strategies also benefit from time decay. Options lose time value daily, which accelerates in the last month before expiration. For this reason, many traders prefer to establish these trades within 30 to 45 days of expiration. By selling options with shorter expiration dates, you can benefit from the passage of time, provided the underlying asset remains within your desired range and the short options are not assigned. Volatility also plays an important role. Higher implied volatility tends to inflate options premiums, which is advantageous for option sellers. Excessive volatility can heighten the risk of substantial price swings, potentially jeopardizing the strategy's profitability. Ideally, you should establish these trades when the implied volatility is high and you believe it will fall. This allows you to collect a higher premium up front. The flip side is that higher volatility also means greater risk. The stock or index is more likely to move outside your profit range. A sharp spike in volatility can cause your position to lose money quickly, so it is vital to have a good understanding of future volatility when establishing these trades. An important risk to consider with iron condors and iron butterflies is the possibility of early assignment on the short options. When you sell an option, the buyer has the right to exercise it at any time before expiration. If exercised, you will be obligated to buy or sell the underlying stock at the strike price. This is more likely to happen with the short options that are in the money or close to the money. For example, if you sell the 50 call as part of an iron condor and the stock rises to $51, the call is now in the money. The buyer may exercise it, forcing you to sell the stock at $50 even though it's trading at $51. This is known as assignment risk. If you did not already own the shares, you would have to buy them at the market price and sell them at the strike price to satisfy your obligation. Early assignments can disrupt your strategy and potentially lock in a loss. It can also tie up a large amount of capital if you are assigned stock. This may occur because of earnings or an upcoming dividend being paid. To avoid this, many traders close out their short positions before expiration if they get close to the money. You can also consider using European-style options, which can only be exercised at expiration. While assignment risk is always present with short options, it's manageable if you stay alert and have a plan. Monitor your positions closely, especially as earnings, dividend payouts, or expiration approaches. Have enough buying power in your account to handle potential stock assignments, and be ready to adjust or close your position if necessary to avoid unwanted assignments. To assess an iron condor or iron butterfly trade, you need to know the maximum risk, maximum profit, and break-even prices. Here's how to calculate each. The maximum risk is the most you could potentially lose on the trade. It's the difference between the strike prices of the options you bought and sold minus the premium you received. This assumes the difference between the calls and puts is the same. We will cover an alternative type of strategy later. The maximum profit for an iron condor or iron butterfly is the premium that is received when opening the position. Your max profit for the iron condor occurs at expiration if the stock is between the strikes of the short options for the condor. The iron butterfly achieves maximum profit if the underlying price is at the short strike at expiration. There are two break-even points. They are the strike price of the short call plus the premium received, and the strike of the short put minus the premium received. For example, say you buy an iron condor on a $50 stock by selling the 45 put and 55 call for $1 each and buying the 40 put and 60 call for 25 cents each. Your maximum risk is $3.50. This is the $5 difference between the long and short strikes on either side minus the net premium of $1.50 collected. Your maximum profit is the $1.50 premium you collected. Your two break-even prices are $56.50 on the upside, the $55 strike plus the $1.50 premium, and $43.50, the 45 strike minus the $1.50 premium for the downside. Knowing these key numbers helps you assess if a trade offers a good risk-reward ratio for your outlook. Ideally, you want to risk as little as possible to make your maximum profit and have a wide range between your break-even prices. Using TradeStation's Option Station Pro, it is possible to set stop-loss orders on both sides of an iron condor or iron butterfly to minimize the loss if the underlying price moves against you. For more information, be sure to watch the video on placing activation rules on option orders in the Options Education Center. Iron condors and iron butterflies are market-neutral option strategies for profiting if a stock or index stays within an expected range. To assess a trade, calculate the maximum risk, maximum profit, and break-even points. Ideally, look for a wide range between the break-even prices and a good risk-reward ratio. While they have the potential for solid returns, especially in high-volatility environments, these strategies also come with risks if the underlying price moves sharply up or down. As with any new option strategy, It's crucial to understand how iron condors work thoroughly and to carefully assess market conditions and your own risk tolerance before putting any real money on the line. One of the best ways to gain experience and build confidence with iron condors is to practice trading them in a simulated environment. TradeStation offers a simulated trading mode that allows you to place trades with virtual money in real market conditions. This lets you see how the strategy performs in various market scenarios without risking any actual capital. As you practice, pay attention to how the position behaves as the stock moves, implied volatility changes, and time passes. Notice how the profit and loss fluctuate and experiment with different entry and exit points. This hands-on experience is invaluable for understanding the strategy's nuances and developing a trading plan that aligns with your goals and risk profile.